At 2:47 a.m. Eastern Time this morning, Wednesday, April 22nd, 2026, something happened in the silver market that the banks did not want you to wake up and understand. Silver hit 75.65. Not because supply increased, not because demand collapsed, not because any fundamental changed in the physical market. It hit $75.65 because someone needed it there. And by 7 a.m., when most of you were drinking your first coffee and checking your phones, silver had already recovered to $78.94. The trap had been set, sprung, and cleared before the American retail investor even opened their eyes. Today, I'm going to show you exactly who set that trap, exactly why $75.65 was the specific target price, and exactly what the recovery from that level tells you about where silver is going in the next 7 days. Because what happened between 2 a.m. and 7 a.m. this morning is not just an overnight volatility story, it is a complete blueprint of how institutional money manipulates the COMEX paper market during thin liquidity windows to solve a very specific and very urgent financial problem. And that problem has a deadline, 7 business days from right now. Let me start with the crime scene data, because that is exactly what 2:47 a.m. looks like when you examine it properly. At 11:30 p.m. Tuesday night, COMEX silver was trading at $79.40. Volume was thin. The overnight session typically trades at roughly 8 to 12% of daytime volume. That thinness is not accidental. It is the environment that makes price manipulation cheapest to execute. To move silver $1 during New York's peak trading hours between 8 a.m. and 2 p.m. requires significant capital because you are fighting against thousands of traders on the other side of your order. To move silver $1 during the overnight session at 2 a.m. requires a fraction of that capital because there are almost no counterparties to absorb your selling pressure. The overnight session is where the math of manipulation works most efficiently. Between 11:30 p.m. and 2:47 a.m., a concentrated series of sell orders hit the COMEX electronic trading system. Silver dropped from $79.40 to $75.65. That is a $3.75 decline, a 4.73% move, executed in approximately 197 minutes during the thinnest trading window of the entire 24-hour cycle. Simultaneously, Brent crude oil was spiking from $94 to $102. Gold was dropping from $4,180 to $4,777. These 3 moves happening at exactly the same time tell a very specific story. The selling pressure was not coming from fundamental repositioning. It was coordinated paper liquidation designed to trigger stop losses and margin calls in the silver futures market at the precise moment when geopolitical headlines would provide perfect cover for the move. Here is the genius of the trap. If silver drops 4.73% on a random Tuesday night with no news, traders immediately suspect manipulation. Questions get asked. Investigations get opened. But if silver drops 4.73% on the same night that the U.S.-Iran ceasefire expires, J.D. Vance cancels his diplomatic flight to Pakistan, Iran refuses to send negotiators to Islamabad, and Brent crude spikes to $102. The narrative writes itself. Silver fell because war risks spiked the dollar. Silver fell because inflation fears pushed Treasury yields higher. Silver fell because of Iran. That is the cover story. And it is a perfect cover story because it contains enough truth to be believable while concealing the actual mechanism underneath. Now let me show you the mechanism. The COMEX May silver contract has 241.8 million ounces of open interest. Registered physical silver in COMEX vaults stands at 76.9 million ounces. First notice day is 7 business days away. This is the specific financial problem that the concentrated overnight selling was designed to solve. When first notice day approaches, contract holders who want physical delivery must stand for it. If delivery demand exceeds the registered inventory, the COMEX faces a delivery failure. A delivery failure on a major futures exchange is not just an embarrassing headline. It is a legal and financial catastrophe that triggers regulatory intervention, destroys exchange credibility, and exposes the 7.6 to 1 paper leverage ratio as the fiction it has always been. The solution to excess delivery demand is simple and brutal. Crash the price before first notice day. Every dollar you can knock off the silver price between now and April 29th is a dollar of pain for every long contract holder. And pain has a very predictable effect on leveraged traders. They sell. When a trader bought silver futures at $80, expecting it to go to $90 on war premium, and the price crashes to $75.65 at 2 a.m., that trader has 3 choices. Hold through the pain and risk further losses. Add margin to keep the position alive and risk even more capital, or sell and take the loss. The overnight crash to $75.65 was specifically engineered to maximize the number of leveraged long holders who chose option 3. Every long position that gets liquidated at $75 is 1 fewer contract that can stand for physical delivery on April 29th. The COMEX delivery pressure drops. The registered inventory survives another month. And the paper silver fiction continues. This is not speculation. The evidence is in the recovery itself. If silver dropped to 75.65 because of genuine panic, selling driven by real ceasefire collapse fears, the recovery would have been slow and grinding. Real panic does not reverse in 4 hours. Real fundamental selling takes days or weeks to work through. But silver recovered from 75.65 to $78.94 in under 4 hours. That 329 recovery happened because the selling pressure was artificial and finite. Once the stop losses were triggered, once the margin calls were executed, once the weak hands were flushed, there were no more forced sellers. And the physical buyers who had been waiting for exactly this kind of dip stepped in and bought everything available below $77. Those physical buyers are the other side of the trade that the banks do not want you to understand. While paper silver was being smashed to $75.65 on the COMEX, the Shanghai Gold Exchange physical price barely moved. This morning's Shanghai AM fix came in at $90.89 per ounce. Yesterday's Shanghai PM fix was $90.30. Physical silver in China went up 59 cents, while paper silver in New York crashed $3.75. That divergence is the proof of the bear trap. Real selling pressure affects physical markets. Artificial paper selling does not touch physical markets because physical metal does not exist in sufficient quantity to be sold down by paper order flow. Shanghai's physical price held because there was no actual silver to sell in Shanghai. The selling was entirely a COMEX paper transaction that temporarily disconnected from physical reality. Here's the specific number that defines that disconnect today. The spread between COMEX paper silver at $78.94 and Shanghai physical silver at $90.89 is $11.95 per ounce. As a percentage, Shanghai physical trades at a 15.1% premium over New York paper. This spread existed before the overnight crash. It widened to over $15 when COMEX hit $75.65, and it is partially compressed back to $11.95 as COMEX recovered. But it is not closed. It is not closing. And the reason it is not closing is the most important structural fact in the entire silver market right now on Wednesday, April 22nd, 2026. The arbitrage that should close this spread, buying silver cheap in New York and selling it expensive in Shanghai, requires physical metal to flow from west to east. But there is no excess physical silver in New York to send to Shanghai. The COMEX registered inventory of 76.9 million ounces is already spoken for by 241.8 million ounces of paper claims. You cannot arbitrage a spread when the cheap side of the trade has no physical inventory. The $11.95 premium is not an opportunity. It is a signal. It is telling you that the physical silver market has already separated from the paper silver market and that the reconnection, when it comes, will happen violently and in one direction only. Now let me give you the banking data that connects directly to this morning's bear trap, because the Commitment of Traders report as of April 14th, 2026, showed something very specific about commercial positioning. Commercial traders, which is the COT category that includes the large banks and dealers who make markets in silver futures, held a net short position in silver. Commercial shorts are not bearish bets in the traditional sense. They are hedges against physical inventory and delivery obligations. But the concentration of that short position tells you who has the most to lose from a delivery rate spike on May contracts. The banks that are short paper silver contracts need the price to stay low and the delivery rate to stay minimal. Every dollar silver falls before first notice day reduces their short position losses. Every leverage long that gets flushed out of the market reduces the number of contracts standing for delivery. JP Morgan's delivery activity pattern in January 2026 was particularly revealing. During the week, when 33.45 million ounces were withdrawn from COMEX registered vaults, JP Morgan was the primary delivery notice issuer on approximately 99% of the notices filed during a specific key week, while open interest was simultaneously rising. That pattern, issuing delivery notices while open interest rises, indicates that new short positions were being opened specifically to absorb delivery demand. It is the paper market's pressure relief valve operating in real time. And that same mechanism is being preloaded for the May delivery cycle right now. Let me now show you 3 data points from Wednesday, April the 22nd that nobody in the mainstream financial media connected to silver today, because each one independently moves silver's price trajectory for the next 30 days. Data point 1. The Bank of England's Governor Andrew Bailey issued a statement this week warning of a, quote, big energy shock pushing up prices. The Bank of England is not the Federal Reserve. It does not set U.S. monetary policy, but Bailey's warning carries enormous weight for silver investors for a specific reason. The LBMA, the London Bullion Market Association, is the world's largest physical gold and silver trading hub. It processes approximately $30 billion in silver transactions daily. When the BOE governor warns of an energy shock, LBMA participants immediately begin pricing that shock into their physical metal positions. Silver lease rates at the LBMA were recently reported at 39%, which is an extraordinary number that reflects the extreme tightness of physical silver lending markets in London. When lease rates are 39%, institutions willing to lend silver are demanding 39% annualized compensation for the risk of not getting their metal back. That number tells you everything about physical scarcity in London's wholesale market. Data point 2. The gold-silver ratio hit 61.9 on Tuesday, April 22nd, widening from 59.7 on Monday. That 2-point widening in 48 hours reflects institutional money rotating from silver into gold as geopolitical uncertainty spiked. But here's the specific historical context that makes 61.9 meaningful. In March 2020, during the COVID crash, the gold-silver ratio hit 124. Silver was massively undervalued relative to gold and subsequently outperformed gold by 400% over the following 18 months. In 2011, when silver hit $49, the ratio was 32. The ratio has oscillated between those extremes for decades. At 61.9 today, we are closer to the middle of the historical range. But the direction of movement matters as much as the level. A ratio moving from 59.7 to 61.9 in 2 days, while the COMEX is under delivery stress and Shanghai is paying $12 above COMEX prices, is a ratio that is about to reverse sharply. When it reverses, silver outperforms gold significantly. Data point 3. Gasoline prices in the United States increased 21.2% in March 2026. That is the largest single-month gasoline spike since 1967, 59 years. When gasoline spikes 21% in 1 month, consumer purchasing power takes an immediate hit. But the more important consequence for silver is what that gasoline price does to mining costs. Every silver mine on Earth uses diesel fuel to power excavators, haul trucks, pumps, generators, and processing equipment. When gasoline spikes 21%, diesel follows within weeks. A 21% fuel cost increase translates directly into 8 to 12% higher all-in sustaining costs for silver miners. Fresnillo already cut 2026 production guidance by 9%. First Majestic already cut guidance by 11%. Those cuts happened before March's 21% gasoline spike was fully priced into mining operations. The second round of guidance cuts, forced by fuel cost reality, has not yet been announced. When it comes, it removes additional ounces from already deficit global supply. Now let me connect the overnight bear trap to Tesla's earnings call tonight at 5:30 p.m. Eastern Time, because these two events are more directly linked than anyone has reported. Tesla delivered 358,023 vehicles in Q1 2026, missing the consensus of 365,645 by 7,622 units. Tesla produced 386 vehicles, building 50,263 more cars than it delivered. Tesla's energy storage division deployed 8.8 gigawatt hours in Q1, down 38% from 14.2 gigawatt hours in Q4 2025. These three numbers are the industrial silver demand story for Q1. They are not good, and the banks know they are not good because Tesla's production and delivery data was published weeks before the earnings call. The overnight crash to $75.65 was timed perfectly to coincide with the worst possible narrative combination. Ceasefire collapse plus weak Tesla industrial demand, pre-data plus COMEX delivery pressure, maximum bearish headline risk and a minimum liquidity window. The recovery to $78.94 happened because the physical buyers knew exactly what the banks were doing and stepped in at $75.65 with real money for real metal. The question for tonight is whether Musk's call at 5:30 p.m. gives those physical buyers a second entry point, or whether it provides the catalyst for the next leg higher. Specifically, watch for two things in tonight's Tesla call. First, energy storage guidance for Q2. If guidance comes in above 12 gigawatt hours, the 38% Q1 decline gets framed as a seasonal anomaly, and silver's EV demand story recovers immediately. If guidance is below 10 gigawatt hours, the industrial demand weakness becomes a trend, and silver faces additional paper selling pressure tomorrow morning. Second, any mention of Terafab capital allocation, Tesla's AI computing infrastructure project, has been excluded from all published guidance. If Musk puts a dollar figure on Terafab tonight, even a preliminary commitment, the silver demand implications are so large that they overwhelm every other data point in tonight's earnings call. Here is the stagflation data in concentrated form because every number here matters for silver's monetary argument. March CPI 3.3%, highest since May 2024. Monthly CPI increase 0.9%, steepest since June 2022. Q4 2025 GDP growth 0.5%, Fed funds rate 3.5%, real interest rate 0.2%. That is the stagflation trap defined in 5 numbers. The Fed cannot cut because inflation is too high. The Fed cannot hike because growth is already near zero. Real rates are essentially zero, meaning there is no opportunity cost to holding silver. And the FOMC meets in 7 days on April 29th with no confirmed Fed chair because Kevin Warsh's confirmation is blocked by Senator Tillis and Jerome Powell's term expires in May. A leaderless Fed meeting in the middle of a war, with stagflation confirmed, with a COMEX delivery crunch 7 days away, is not a scenario that any monetary policy textbook has prepared anyone for. And the uncertainty it creates is precisely the environment where physical silver held outside the financial system has maximum value relative to paper claims within it. Let me give you the complete supply destruction picture for Wednesday, April 22nd, 2026, because these numbers have not changed despite everything that happened overnight and despite everything that will happen tonight. The Silver Institute's World Silver Survey 2026 confirmed 6 consecutive annual silver deficits. The 2025 deficit was 40.3 million ounces. The 2026 projected deficit is 46.3 million ounces, 15% larger. Cumulative deficits from 2021 through 2025 total 762 million ounces drawn from above-ground stockpiles. China's export license regime restricting silver to 44 authorized exporters has been active for 113 days. China's sulfuric acid ban threatens 70% of global silver byproduct supply. Chile's sulfuric acid prices spiked 44% in 1 month from Chinese supply disruption. The Section 301 investigation targeting Mexican silver, which supplies 25% of global production, has a public hearing on May 5th, 13 days away. The overnight bear trap to $75.65 did not add a single ounce to any of those deficit numbers. The recovery to $78.94 did not close the 762 million ounce structural hole. The banks can crash the paper price to $75 in the overnight session. They cannot create silver that does not exist. They cannot fill deficit years that have already passed. They cannot rebuild registered COMEX inventory that has fallen 68% in 6 years from 240 million ounces to 76.9 million ounces. The bear trap is a temporary paper market event. The structural deficit is a permanent physical market reality. And that is the complete picture of what happened between 2 a.m. and 7 a.m. this morning on Wednesday, April 22nd, 2026. The banks needed 75.65s. They got it in 197 minutes during thin overnight trading using ceasefire headlines as cover. Physical buyers stepped in immediately because 75.65 is a gift relative to $90.89 Shanghai physical. Silver recovered to $78.94 by morning. The trap was sprung. The weak hands were flushed, and the May delivery clock is still counting down. 7 business days, 241.8 million ounces of paper, 76.9 million ounces of physical. The recovery from 75.65 was not a relief. It was the setup for what comes next. And what comes next has a very specific date on the calendar.